So we just finished the capital asset pricing model and the dividend valuation model. We start the new chapters. We just finished the business finance on the cost of capital, finished the capital structure, the capital asset pricing model. Then we move on. Still the topic under business finance, but it is about the source of finance. Okay, it's about the source of finance. We will finish it by introducing different sources of finance, including internal, external, debt, equity, and also some explanation of the stock exchange. So first of all, what to consider, okay, about the sources of finance. First to consider is, okay, don't go to details about debt financing or equity financing. Before going into debt financing and equity financing, you first ask yourself, is it any internal financing possible? Because when you talk about debt financing or equity financing, a lot of students I can see is they only focus on external financing part. They forget about internal financing. Okay, because it's possible for the company to use the internal funding instead of going out to the public market to get money for investment. So first to consider is internal or external. And next is, okay, if you decide to go external financing, then debt or equity, because you go to the markets to get the money back. It may change your capital structure. It may. So what's the advantages and disadvantages of each type of sources? The factors considered in choosing internal or external finance are, first of all, tax. Okay, for taxation. If you, for example, if you would like to use the internal generated cash flow to finance your projects, it means your dividend will be affected. You cannot pay dividend, but the shareholders will be benefit from the capital gain because you announce the projects and the market realize the projects will have the positive NPV, the positive net present value to the company, and they will buy the shares. They will go in the market to buy your shares and bid up the price. So the people, the shareholders right now holding your shares will benefit from the capital gain. But they have different tax rate between dividend and capital gain. Okay, different tax rate. Different tax rate between the capital gain and dividend. So it depends on the tax rate. The other factors to be considered is about the transaction cost. For dividend, in general, there's no or very minimal transaction cost by receiving the dividends. But if you sell the shares, okay, you have to pay brokerage fees, commission, or the stock exchange transaction fee, or maybe, for example, duties to any government. So you have some transaction costs related by selling the shares. Maybe some shareholders, they don't like it, okay, because they have to pay the extra cost. They would prefer dividend in some example. And for the company itself, okay, raising external finance may give rise to some cost, like issuing cost. Okay, you decide to raise additional equity by issuing new shares. Then you have, for example, to fund an investment bank or a merchant bank for you to issue the new shares to fund the new investors, and it incurs some external cost, which is may not be feasible. Okay, if your money raised is not so much, if, for example, if only just few million US dollars, then the issuing cost may be so high, it's not worthwhile to do it. And also market expectation. Okay, in general, cutting dividend is not a good signal to the investors because, for example, the investors will consider whether it is any liquidity problem of the company, so they cut the dividends. Why dividends is cut? Okay, they will just spreading the rumors about the company is not in good health or good shape. So it will eliminate any capital gains. So cutting dividends is very cautious to some listed company. And the last one is liquidity preference. Shareholders may demand a cash rather than capital gain. So they just sell the shares if no dividends pay out. Okay. But if the dividend distributed by the company, they prefer to get the dividend instead of selling the shares, because they would like, for example, if for a shareholders which hold substantially number of shares in the company, they would like to hold the shares by getting more dividends. So next part, okay, we just finished our consideration. We decide, for example, a company decide to go into external financing. Then it's between debt and equity finance. So what's the consideration? First of all, it's about the voting right. The voting right. For debt holders, do they have any voting right? No. Okay. But if you issue new shares, then the voting right will be changed. The shareholder structure will be changed, and the voting right will be shifted to some more new investors. And interest cost and versus dividends. Okay, interest cost. Okay, here. Some tax benefit. Dividend, in general, no tax benefit. Okay. And also, the debt holders require lower rates of return because they have the right to claim the distribution of asset if the company is liquidated or go into bankrupt. Okay, but for the equity holders, they are the last one to claim any residuals of the company when it's liquidated. And capital gearing. Okay, if you increase your debt capital, undoubtedly your financial risk increases. For tax, interest payment, okay, you got some tax benefits, but for dividends, you cannot have any dividend tax benefits. Okay. So we talk about debt, then some additional points we'd like to highlight for debt. So first, okay, you can see the new terms, okay. The new terminology is term structure of interest. Okay. It's about a short and long term or medium, the short term, medium, or long term. Okay. For different term structure, for different term of the loan, for example, short term loan means maybe 1 to 3 months. Medium maybe 2 to 3 years, long term maybe 5 years. Okay, so you have different interest rate. For example, in the short term, you may only pay per annum, maybe only 3% per annum. Medium maybe 4%. With long term loan, maybe 5 years, maybe for example 6% per annum. Okay, why is it happen? Okay, we'll explain it in the risk management parts, but in general, okay, if you raise a short-term funds, you pay less interest expenses. So non-renewal, okay, when you borrowing money from a bank or from whatever source, if a short-term loan, you have to renew it because after 3 months, the loan matured And then if you don't have any sufficient cash to repay all the loan principal, then you have to raise a new funding, because you have to pay back the mature loan. Okay, the loan matured, so you have to pay back all the money back. So there's a loan renewal or transaction cost. And flexibility and risk. Okay, short term versus long term. So what does it mean? Okay, in short term loan, it's more flexible. And you can just quite easy to suit for the company requirements in the short term. Okay, long term, that okay, once you raise the funds, and then it's fixed for a period of time, and also it's not so easy or so liquid to have the market response on your long-term debt request. So it's not so flexible. And for the risk to a company, short-term loan is a higher risk than long-term loan, because the short-term loan you have to roll over. Okay, you have to roll over the short-term loan. You can't repay. Okay, and future interest rate. Okay, for future interest rate, the short-term loan will be preferred to long-term loan, because once the interest rate you expect to fall in future, short-term loan, okay, you can just rearrange another short-term loan in a very short-term period of time to have a better rate.